Ishmael Radikoko. Good evening and welcome to Botswana Tonight.
Good evening and thank you for having me.
Now, quite often the MPC of the Botswana Bank of Botswana comes up and says, well, we're keeping this at the same rate, we're reducing the rate, we're picking the rate. But do we actually know what that means and the impact on ordinary citizens? I mean, we're talking about keeping the rate at 1.9% for example. What in actual sense does that mean to me?
Yeah, so the Monetary Policy Committee of the Central Bank is basically a committee that is there to implement the monetary policy itself. And there are several tools that are actually used to affect this policy. But the whole intention is basically to try to control the level of money supply in the economy. So several tools can be implemented, which include using interest rate, using reserve requirement, or using what you call open market operation. But there are other tools that can be used, but those are the three most common tools that the central bank through its monetary policy committee normally uses. Now the 1.9% that you just referred to is that interest rate that I'm talking about, which is a tool that can be used to influence money supply. So normally what that basically means is that if they change that rate, they are basically either increasing interest rates in the economy or reducing interest rates in the economy. And what that means is that obviously if interest rates in the economy are to go up, which will be influenced by the decision of the central bank to do that, that means it will be very difficult for people to access loanable funds from commercial banks because it will be expensive to access money. But if it drops or the bank decide to take it lower, it means that they are trying to bring down the interest rates and the economy lower, or cost of borrowing, which will basically stimulate the economy, as many people will be able to access loanable funds from financial institutions and be able to increase economic activity.
Okay.
Yes.
Now, we also talk about reducing the primary reserve requirement to zero. What does that mean and how does that translate to my day-to-day?
Yes, and that will be another tool that can be used by the central bank to influence the level of money supply in the economy. So the reserve requirement is basically that amount of deposit which the central bank require commercial banks to a portion of that deposit, as people are depositing money in the commercial banks. There is a certain portion that is required to be deposited with the central bank. We call that reserve requirement. So it used to be 2.5 before they are reducing it now down to 0%. So at 2.5%, basically what it meant is that when people are depositing money or companies are depositing money with the commercial banks, 2.5% of that deposit goes to the central bank in that reserve, but it's a non-interest earning account, but it is just used to basically try to inject liquidity back into the market in case maybe there is no enough money that commercial banks can lend to people. So by reducing it down from 2.5 to 0, they are basically injecting a certain amount of money back into the commercial banks so that commercial banks can have enough liquidity or enough loanable funds that they can be used to lend to the economy or to businesses and individuals.
Okay, I think it's quite interesting. From we talk about increasing liquidity. I mean, if you cap at 1.9, it means more people are able to access loan facilities. Like you speak, it means people can maintain the premiums at the same rate that they've been paying premiums at. But you also talk about commercial banks then having more that such that they're able to loan to the people. It seems we're talking loans, yet we understand the household income debt is high. We understand that there's just a number of challenges from whether people can even afford to get the loans. From an economic perspective, what does this really mean, and what does this translate into as we move along?
Yeah, when you are talking about loans or making it easier for companies and people to access loans, we are not only talking about personal loans. Remember, there are several bank products that have been created by financial institutions. Some are property loans, some are loans which are taken maybe for commercial purposes. And when we are talking about increasing money, we are not necessarily talking about increasing or causing that problem that we have of high personal level of debt. But we are talking about availing loans to the commercial sector, to businesses, to expand their operations, to make sure that they remain in operation, because without funding, it could be a challenge. So that is basically what that will mean in terms of having that enough loanable funds to the economy.
Okay.
The idea is to help businesses to prosper, not necessarily to give to individuals and increase their personal debt.
Now, when we talk about obviously businesses, then are there any businesses, given the structure of our economy, that stand to benefit more out of such a decision?
Well, all businesses tend to benefit from this decision, but remember, each business will be assessed individually in terms of their own credit worthiness. Are they able to access those loanable funds? But this is not particularly beneficial to any sector, because anyone or any business that want to access loans from financial institutions, they can do that. But of course, we know there are some sectors that generally, when you look at the economy, we are inclined to try, as an economy, to try to fund. For example, if you are looking at the manufacturing sector, which because we want to be industrialized and try to diversify our economy from dependent on minerals, particularly diamonds. We are looking at sectors like your hospitality, tourism sectors, which we also want to expand some services, arts and culture, and or the performance industry, basically. So those are the areas that will benefit more, because in terms of even assessment, they will be looked at more favorably by the lenders, as opposed to any other businesses that we can come up with. Because any other businesses, the reason why maybe they are not looked at as key to contribute to diversification is that maybe in terms of competition and all that, we have abundance of those businesses and they contribute less to the economic activity. So those ones in the manufacturing, tourism and hospitality, in the performance sectors, services industries will benefit more, and also ultimately try to benefit the country in terms of diversification.
Now, you talk about actually for commercial businesses having more access. We talk about market liquidity. What would we say led us to a point where we're talking about market liquidity? What are the issues that got us here, and how does this really translate into? Is this a temporary measure? Is it something that we deem moving forward there will be sustainability as far as that question of market liquidity is concerned?
Yeah, the liquidity in the market normally becomes affected when there is a increase in economic activity, and where it's easier for businesses to access loanable funds. So we are now in an environment, or the economic environment, where interest rates are very low. So a lot of people are able to access the financial sector for those loans that we talked about. So as a result of increase in business activity and many companies being able to access those funds, then it means the commercial banks will be in a little bit of a liquidity problem, because there is high demand for money, which they don't have available to lend to all these businesses. And that is why now the central bank decides to drop that reserve requirement, because what they are doing, they are trying to inject liquidity back into the commercial banking sector, so that the banks are now able to have enough of those loanable funds to lend to businesses in the form of credit.
So essentially what you're saying is it's not necessarily a bad thing. It's actually a good indicator that there's demand from a business perspective.
Yes, there is a demand for loanable funds, but the demand exceeds the supply that is available. So when the demand exceeds supply, then the central bank has to come in through using any of the monetary policy tools that I've talked about. So in this case, they've decided to use the reserve requirement, because the reserve requirement is one of the direct tools that can immediately inject the liquidity into the market. But remember, there are other tools, like this, what you call open market operations, where the government or the central bank buys or sells government securities like your bonds, treasury bonds, treasury bills. So they can also inject money into the market by saying, by for example, buying bonds from the market. Because when you buy bonds, they will keep those bonded securities, but then they will issue out cash to those businesses and therefore injecting liquidity into the market. So that is another tool that they can use. But this time, I think they have preferred to use the reserve requirement. But maybe because we know currently there have been talks around whether the country has enough money, maybe the reason why they are not using other tools like deciding to buy securities is because there is no enough money from the government coffers to be able to buy securities and inject liquidity into the market. Because this one, by reducing reserve requirement, they are taking money that was already there, kept in a deposit by the central bank, but which belongs to the commercial banks. They are just simply injecting it back to the market.
Okay, but what then, you mentioned some sectors that you said, well, it's going to benefit everyone, but there are specific sectors that you referenced. From an economic perspective, from an activity perspective, money changing hands, money moving around, money ending up in my pocket, what does this mean generally for the economy, for economic growth?
So when there is we call this quantitative easing, where it's easier for businesses and people to access credit. So what it means to you, maybe as an individual, is that let's say you already have a loan with a bank, and if the interest rates were to be kept as at that rate, or better if they were to go down, that it means your cost of capital will reduce, or in this case, it is maintained where it is, because at the rate of 1.9 monetary policy rate, it translates to also a lower interest rate that commercial banks generally charge to their customers, and so this means cost of capital has gone down. Many people are able to access credit. Many people are able to do businesses. Business activity increases. We expect when business activity increases that there will be available job opportunities, because if businesses are not thriving, they are not being assisted through this tapping into the sources of finance, and they are not expanding, then there will be a problem now of unemployment. So we hope all those other economic problems like unemployment will be solved.
Okay, so basically we solve issues of economic and unemployment, more money into my pocket for those who probably have loans or were seeking to have loans. Let's just talk about, are there any risks really associated with this, particularly when we talk about the reserve requirement? Is there anything that we could say these are the potential risks, and therefore as we venture into these, or as we find ourselves into these are the sort of things that as an economy we ought to look or guard against?
Yes. So like I said, the idea behind having reserve requirement and having some money deposited in the central bank is for the central bank to come to the rescue of the market, especially when there is liquidity problem. Because we don't want to have a situation whereby maybe we experience something that we call a bank panic. A bank panic is whereby a lot of people maybe goes to the commercial banks, they want to withdraw their money, but banks don't have money. And then that can cause instability into the financial markets. So the danger that we have now by reducing this reserve requirement from 2.5% to 0 is that now going forward, it means the central bank cannot use reserve requirement as a tool to immediately, remember I said reserve requirement is one of the tools that will have a direct and immediate impact in terms of injecting the liquidity into the market. It will have to now resort to other tools which might not be as quick and effective as using the reserve requirement, because there is no money. There is no money in the central bank in the form of reserves that the bank can immediately inject into the market. So it might be forced to resort to open market operation, like I said earlier, or to using interest rate. But interest rate, when you use them, they have that lagging or lagging impact in terms of influencing money supply into the economy. So if you use those other tools, it might take time before we can see the impact in terms of supply of money in the economy. But now this is the danger that we have by reducing the reserve requirement, because it means now the central bank will not be able to immediately step in cases where there is a bank panic or increased levels of low liquidity into the market.
Okay, so what would lead us to that bank panic, to low liquidity in the market, when we accept from your explanation, we accept from the statement of the Bank of Botswana that doing this was going to increase market liquidity? Why would we, for whatever reason, not be able to get the liquidity that we are hoping to get?
Well, repeat your question again.
You mentioned that now that we've used the primary reserve requirement,
Yes.
The downside is that should there be issues of liquidity, we cannot use it again. We'd have to go to other instruments.
Yes.
And I'm saying, if the intended purpose is market liquidity, what would lead us to having to go back and say, what other instrument can we use? Are we saying this is not a sure way, a proven framework that we do this, there certainly would be liquidity?
No, what will force us to wanting to or the central bank to, or the monetary policy committee to wanting to use other instrument is because, like I was saying, the moment you leave the reserves which are deposited with the central bank to go down to 0, it means you don't have any money that you can inject back to the economy. So what will lead the bank now to be forced to use this other tools is the fact that they cannot now use the reserve requirement because there is no money that they can inject back to the economy. So they will have to now maybe use other tools, like I said, maybe through issuing bonds or buying bonds. Because if you are to buy bonds, like I said, this other instrument will have a lagging impact in terms of what the central government, central bank wants to do. For example, if you are to talk about maybe buying or issuing government securities, this normally happens on quarterly auctions. So quarterly auctions means after every 3 months. So if you want to inject liquidity into the market, but we have just performed an auction now, that means the next time for the government to do another auction will be in the next 3 months.
Yes.
But what will happen in terms of liquidity in the banking system between now and the next 3 months? There will be a problem. There will be a big panic, and if people and obviously ultimately that will lead to maybe strict measures in terms of how now banks will assess people to access loans. They will become more stricter as a way of trying to reduce the number of people now who will be able to qualify for the loans, which is something that can be also detrimental, because it means you will possibly reject some loans which could have had positive impact to the economy. You are doing that because you are constrained in terms of available credit that you can do, and that being caused by the fact that the market itself has a problem of liquidity, which the government through the Bank of Botswana cannot act to immediately and have an immediate impact in terms of restoring that liquidity.
Okay, thank you so much, Mr. Ishmael Emmanuel, an economist speaking to us.
Ishmael Radikoko.
Thank you so much, sir. Ishmael Radikoko, an economist, speaking to us about the Monetary Policy Committee and actually the decision that was made to reduce the primary reserve requirement to 0% and what that means and the impact that it is envisioned to have on the economy, to have only the pennies that end up in your pocket. Benson Puteho is up next with the 7 o'clock news bulletin.
Letamo galena mitsi mo nakong ya gompieno le kgadile ka gore mo lube le mo go 33%, mme mo nakong e hitileng le ne la kgala gape ka 2012 ne la kgala la ya go ya ko 25%. Re lebile gore dipula di tla nna botoka ka gore ba tepolo api ba rile dipula di tla nna botoka gongwe le tla tokagala, mme a le sa tokagale go tla bo go raya gore re seka-seke re lebile ka ga tsamaisa matamo ka teng, gore na le mo go teng di-drought measures.